WorldCom was a top Fortune 500 company in the telecommunications industry in the late 1990s. The investigations surrounding the fraudulent reporting for WorldCom shed new light on reporting in the accounting industry and relationships between organizations, internal and external audit firms. In this presentation, those involved, the events and the repercussions of the fraud and the investigation are discussed. The orange in this graph depicts the major players in the chain of command in investigating the fraud in WorldCom. Cynthia Cooper worked her way up the chain of command around the accounting functions within WorldCom, climbing towards Scott Sullivan. She worked her way through Troy Normand and Betty Vinson, who both held positions as directors in charge of reporting, a major role surrounding the reason for fraud in WorldCom. When Cynthia Cooper started investigating the capital expenditures, she first looked to Arthur Andersen for explanations of inflated amounts reported and supported by WorldCom executives and external auditing of Arthur Andersen's audit team. With no help from Arthur Andersen, Cooper decided that her team, including Gene Morse and Glenn Smith, should investigate the situation further. She then brought many of the concerns to Scott Sullivan, who was not willing to contribute to the investigation. After finding major red flags of fraud within WorldCom, Cooper and her team approached Troy Normand and Betty Vinson, who answered to Buddy Yates, the Director of General Accounting. With the breakup of AT&T, Bernie Ebbers would enter into the telecommunications field by selling long-distance services at cheaper rates. Ebbers and other business partners started long-distance discount service in 1983 in Hattiesburg, Mississippi, just before operations started in 1984. Over the next 10 years, LDDS merged with or acquired 30 companies, Advantage Company being the company that took LDDS public. At the 10-year mark for LDDS, the company was considered the fourth largest long-distance carrier in the United States, reaching nearly $1 billion in sales. Following the success of the first 10 years, shareholders in the company voted on changing the name from LLDS to WorldCom following the merger with IDB Communications Group in 1994 and the acquisition of Williams Telecommunications Group, Incorporated, in 1995. The Telecommunications Act of 1996 allowed long-distance service carriers to compete in local markets. After purchasing MFS Communications Company, Inc. and MCI, WorldCom became a full-service telecommunications company with the ability to broaden the target market to any size business. With WorldCom gaining much market share through large-scale mergers, the U.S. Department of Justice, with help from European regulators, blocked the merger on the grounds that it limited competition in the telecommunications marketplace. Following the success of WorldCom, Ebbers began to maintain a lifestyle that matched his greedy personality. Ebbers began taking out large loans and mortgages to finance his lifestyle and used his WorldCom stock as collateral. Through many private business ventures and personal relationships, Ebbers was able to live an extravagant lifestyle all on the basis of the value of WorldCom stock. When market changes ensued in early 2000, many investors sold telecommunications stock after Robert Rubin spoke of the economic risks surrounding the overvaluation of the stock. With the intense pressure to keep the stock price of WorldCom competitive, Scott Sullivan began reclassifying expenses as capital expenditures through line cost capitalization. Additionally, he wanted to tamper with the timing of accruals by not matching the expenses with revenues on the income statement. Sullivan wanted the accruals released on the grounds that the MCI merger had created a substantial amount of over-accruals. The creative accounting tactics began in 2000 and continued through the company's bankruptcy. Scott Sullivan and David Myers began ignoring objections to the accrual releases, following the culture Ebbers set to become the highest stock in the market. Sullivan, Myers, and Buford Yates approached Betty Vinson and Troy Normand to conduct the journal entries, using legitimate reward and coercive power to intimidate the accounting department. Cynthia Cooper began her routine audit of capital expenditures in August 2001. Following a complaint received in March 2002, Cooper became concerned and revamped the audit into a deeper investigation into the company's accounting department, expanding the scope to a full financial audit. Simultaneously, the Securities Exchange Commission started an investigation into WorldCom to figure out why WorldCom was profitable in a declining market where all other telecom companies reported losses. As investigators started zoning in on fraudulent issues within the company and significant drop in WorldCom stock, Ebbers resigned as the CEO. May 2002, WorldCom admitted to inflating earnings and became the firm that committed the largest accounting fraud in history. After filing bankruptcy in July 2002, the revised financial statements uncovered $9 billion worth of improper accounting procedures. By the end of 2002, Cynthia Cooper was named Persons of the Year by Time magazine for her investigation into the fraud. Over the next few years, courts found Ebers, Myers, Yates, and Sullivan guilty of multiple felony charges, including securities fraud, conspiracy to commit fraud, and making false filings with the SEC. Benson was sentenced to prison and house arrest. In 2006, Bernie Ebers entered prison and must serve at least 85% of his 25-year sentence. In the next section, the facts surrounding the WorldCom case are discussed. We believe the boundary between earnings management and fraudulent reporting is in the dark gray area, the area between the gray and black of accounting principles and rules. It is justifiable for companies to smooth their earnings to a certain extent. For example, when earnings of a company fluctuate greatly, this can send wrong signals to the market and make the market unstable. There is a fine line between smoothing the earnings to provide consistency for growth and making absurd changes to the financial statements to artificially inflate earnings solely for the purpose of improving stock price. The motive behind WorldCom's fraudulent reporting started from wrongly set ambitions of the company's CEO, Bernard Ebers. As mentioned in the case, his main goal was not to capture market share or globalization, but to simply bring their stock prices up as much as possible to hold the lead on Wall Street. One of the other incentives that proves this point was Ebers' personal interest in his personal holdings. According to the case, he owned many unrelated businesses ranging from Douglas Lake, Canada's largest ranch, BTC Holdings, a yacht building and repair company in Georgia, and even a minor league hockey team based in Jackson, Mississippi. Most of these acquisitions were through a commercial loan secured by his personal shares of WorldCom stock. This was a big incentive for Ebers to encourage his employees to drive their stock price higher each quarter. There were pressures coming from many different sources that forced the managers and executives to change the reports, which led to manipulation by employees and the eventual bankruptcy of WorldCom. Most importantly, pressure was coming from the CEO at the time, Ebers. When the most influential person in the company has interest in stock price increases at a personal level, the tone at the top can mislead and put negative pressures on the people under his or her control. Pressure from Ebers created a manipulating and intimidating culture that further influenced the culture of the organization. There were many instances where senior managers would use inappropriate and intimidating language to employees in order to arrive at a desired result and to assure that they would not disclose certain information to the auditors. Many of these employees, including Cooper, felt threatened and pressured to cook the books due to the intimidating pressure from the boss. As previously described, the corporate culture of WorldCom was lacking several vital aspects of an ethically successful company. First, the company did not have a set code of conduct that the employees were encouraged to abide by. Through its aggressive acquisition strategy, the company consisted of individuals and systems with wildly different backgrounds. The chief officer's attitude towards the written conduct did not help either. The case mentions that when proposed about a project to establish a code of conduct, Ebers referred to it as a colossal waste of time. In addition to not having a set code of conduct, the actions of the managers were unethical and, in some cases, threatening to employees. The firm also lacked a sense of transparency with the auditors. The actions and decisions of Ebers included falsifying reports that went to Arthur Andersen, the independent auditor of the company at that time. Every element of the fraud triangle was believed to be present in WorldCom's case. First, there was an immense pressure on the company that forced many of the employees to commit fraud. Starting from the CEO himself, there was a pressure for him to drive up the stock price due to his loans from the company, secured by his personal shares of WorldCom stock. The senior managers had pressure from Ebers to maintain the ER ratio, which led to improper expense capitalization, accrual releases, and the concealment of information to auditors. Next, there was significant opportunities for the senior management and managers to perpetrate such fraudulent activities. For instance, when Timothy Schneeberger, director of international fixed cost, refused to release the accruals requested by David Myers, controller, one of his subordinates who had access to the general ledger booked the entry without notifying the appropriate department. Also, one of WorldCom's wrongdoings, withholding information and altering documents that went out to the auditors, gave management a bigger opportunity to conceal their fraudulent adjusting entries. One rationalization of fraud for employees was that the top executives supported the creative accounting. If managers thought it was okay, why should a subordinate question the procedure? Additionally, Betty and Troy figured that the fraud would only occur one time. As a subordinate in this situation, understanding the consequences of one creative journal entry is hard to forecast, especially with so much pressure from executives. Employees were also worried they might be fired for saying no. The rationalization for Bernie Ebers was that his lifestyle depended on the stock price. If the stock price drops, Ebers' financial situation could drastically change. In order to keep his lifestyle, Ebers was willing to alter the numbers. Prepaid capacity is defined as a cost for the access of network systems, usually paid before they are used. The managers at WorldCom would predict the demanded network traffic and then confirm that there was enough bandwidth available to cover the demand. The accounting treatment by WorldCom of these costs are not in accordance with GAAP. The first thing to notice is the difference between operating expenses and capital expenditures. Operating expenses are costs associated with the ordinary course of business, and capital expenditures are costs for acquiring a long-term asset that will bring benefit to the organization throughout its useful life. These payments for the network capacity would fall into the category of operating expenses since the ownership of the cable did not change. WorldCom did not own them, and it was used in the ordinary course of business. Capitalizing these costs, especially under construction in progress, would be an incorrect accounting entry. While the total impact of the WorldCom fraud totaled over $9 billion in improper accounting, the total before detection came to about $3 billion. The impact of fraudulent entries brought a huge change to WorldCom's performance and reputation and affected more than just the company and its employees. Finding a proper valuation of the impact of WorldCom's fraud is hard to calculate considering the private ventures and personal relationships Ebers manipulated in the process. However, in valuing the impact of WorldCom before detection, the main contributor that artificially boosted WorldCom's earnings was the reduction in international line costs. The reduction caused $1.2 billion and $3 billion of artificial earnings boost in 2000 and 2001, respectively. This way, WorldCom could keep the ER ratio around 42%, which was Ebers' main goal for WorldCom. There were many people involved in and affected by the fraudulent activities in the WorldCom case. The most obvious stakeholders are the owners of the company, shareholders, executives, and managers who served sentences for the fraud convictions. These people include Bernie Evers, Scott Sullivan, David Myers, Buford Yates, Betty Vinson, and Troy Normand, even though he did not serve any jail time. Next are the employees, stockholders, and customers who all invested resources into helping the company. Most of the employees lost their jobs, medical insurance, salaries, and retirement plans. Many of the investors lost a lot of money in stock purchased to fund long-term retirement plans and other sources of income. Creditors like Citigroup and other banks lost almost $5.5 billion from the bankruptcy filing. The entire economy was affected by the fraudulent activities of companies like WorldCom. Being such a large company, the market saw large ripple effects when WorldCom lied on financial reports, which caused a lot of mistrust with investing and the public trading markets. Additionally, executives, board of directors, and other employees spent a massive amount of resources reorganizing the company, including John Sidemore, the CEO who replaced Ebers. Rebuilding the company's reputation was nearly impossible after an incident as large and economically suppressing as WorldCom. Customers were a large group of those stakeholders affected by fraudulent activity. One of WorldCom's customers was Tesco, who reaped a lot of consequences to its business from this incident. Tesco had to find a new supplier, which rippled down to how its customers were treated, and as USA Today reports, the customers noticed when changes happened behind the scenes of the operations. Since the case of WorldCom, many changes have been made to educational curriculums to focus studies on identifying, detecting, and preventing issues related to accounting fraud. Two of the most important changes are the Sarbanes-Oxley Act and the COSO framework. Internal control in an organization is one thing every organization must adopt and something WorldCom ignored and avoided. One of the issues at WorldCom was the tone set at the top. Ebers and Sullivan created a culture that supported manipulation, paired with incentives set by external stakeholders that encouraged executives to overlook consequences of improper accounting and created falsified earnings. Even if WorldCom had strong procedures set towards segregating duties, the oversight would have overridden any policies set in place. Another system that is appropriate for companies now, that WorldCom did not invest in, is having a hotline in place for employees, customers, vendors, and managers to contact in case they're uncomfortable with procedures within the company, actions by leadership, or other morale issues. Sullivan and Evers both had strong personalities that would intimidate subordinates who questioned their judgment. Additionally, the board of directors and other committees should have had a thorough understanding and better involvement in operations and decision-making for an organization. This provides oversight far surpassing the owner and executives with greedy tendencies. Following the COSO framework is a way companies can prevent or quickly detect the types of actions that occurred at WorldCom. Shown here is WorldCom's internal audit department responsible for finding the fraud. Cynthia Cooper is on the top left of the slide. Gene Morris is on the top right of the slide. Glenn Smith is on the bottom center of the slide. The internal auditing department was belittled at WorldCom. Many articles state the harshness of that Ebers felt towards the department. Time magazine states, the culture was so anti-jargon that Ebers had ordered her never to use the phrase internal control again. With this type of attitude, Cynthia Cooper had to be persistent and strong in her position as a director of the internal audit department, without the help of executives or Arthur Anderson. In the same article of Time magazine, Cooper is quoted as having the ability to empathize and was comforted was comfortable with stepping on toes if it meant making the right decision. With this stronghold of moral character, Cooper was the foundation of the investigation for the audit team. Jean Morse, at Cooper's request, investigated the journal entries surrounding the large round dollar figures, but with limited scope due to top management's hatred towards the internal audit function. Smith, using his techie skills, found the starting point of concrete evidence to investigate further, large entries without supporting documentation. Glenn Smith, alongside Cooper, interviewed many of the key people surrounding the fraudulent activity at WorldCom and attended audit committee meetings to witness how accounting procedures were described. Additionally, he received a tip for investigation from Mark Abide, the director of property accounting, to investigate other matters surrounding the fraud that would provide evidence in the case. In the final section, ethical behavior surrounding the WorldCom case, focusing on those involved in the fraud investigation, is discussed. Cynthia Cooper was WorldCom's head of the internal audit department. Those in the internal audit department reported directly to CFO Sullivan, one of the main perpetrators of fraud. In August 2001, Cynthia Cooper began an operational audit of capital expenditures and found that corporate had $2.3 billion of capital expenditures, only $600 million lower than the operations and technology department. When Cooper probed further, she was provided with a revised chart that only showed $174 million in expenditures. Luckily, a few months later, the head of the wireless business unit complained about accruals to Cooper. She followed this new lead by inquiring about it to Arthur Anderson, but was again shut out. Cooper decided to extend the probe for operational audit and began to investigate the company's journal entries. Cooper enlisted the help of Jean Morse, an internal audit staffer with technological knowledge, to search the entries after hours. While working as the head of the internal audit department, Cynthia Cooper was ethically obligated to the audit committee of the board of directors as well as the shareholders of the company. As an internal auditor for WorldCom, Cooper's job was not specifically designed to look into financial data. Ebers used the internal audit department to increase operational efficiency. In today's business world, most internal audit departments are responsible for financial information. Those internal auditors should be ethically responsible for correct financial reporting. When Cooper began looking into some of the financial data, she was threatened by CFO Sullivan for her investigation into the wireless business unit. Even though discovering fraud was not part of her job description, Cooper kept probing when she came across things that didn't fit correctly. Cynthia Cooper faced a couple ethical issues while head of internal audit. The first one to present itself was the incorrect use of capital expenditures. She could have ignored the fact that capital expenditures for corporate were unusually high. However, she requested more information. By choosing to investigate further, Cooper brought attention on herself. Unsatisfied with the reasoning she received, Cooper dove deeper into the financial information once other questionable issues came up. Another employee told Cooper that earnings had been inflated by concerning accruals, and Cooper decided to look deeper into what he was talking about. When Cooper inquired of the external auditor, Sullivan exploded. Cooper realized she was getting close to something major because of his reaction. Cooper later told Time magazine, "When someone is hostile, my instinct is to find out why." After inquiring even further of the accounting department, Cooper was called into Sullivan's office and was told to delay her audit. Instead of delaying, Cooper told the head of the board of directors about her concerns, and they called a meeting for Sullivan to explain everything. At each obstacle, Cooper chose the path that was difficult. It would have been easy for Cooper to ignore that certain things didn't quite fit, but instead she investigated and did her best to make sure WorldCom was following ethical requirements. Betty Vinson was the director of management reporting and worked in the accounting department of WorldCom. Once the fraud came to light, it was found that Vinson was an employee who was complicit in the fraud. Her boss, Buford Yates, told her to change the dates on some transactions, and she complied. After the first case of fraudulent reporting, Vinson considered resigning. However, she was worried about her family since her salary was higher than her husband's. Vinson remained at WorldCom and continued to falsify reports until the fraud was discovered. Vinson went to jail because of her actions in the accounting department. Vinson's actions can be looked at in two different ways. Vinson was the one who actually made the changes to WorldCom's books, but has insistently claimed that she was pressured to do so. Comparing her with Cynthia Cooper, Vinson did not try to notify anyone about what was happening. Vinson's actions directly impacted the reports of WorldCom. Arthur Anderson was WorldCom's external auditor. Arthur Anderson is responsible in part for the fraud that occurred at WorldCom. The top auditors were working with Sullivan to find accounting policies that could manipulate earnings. Because of the pressure from Ebers, the auditors and employees were working to ensure the company's ER ratio remained high, since it was one of the main drivers of WorldCom's stock price. The auditors that worked with WorldCom should have realized that the accounting practices were fraudulent. Arthur Anderson reported all findings to the audit committee of the board of directors. Since Arthur Anderson and Sullivan were working together to manipulate earnings, it is not surprising that the board did not probe further. However, simple questions could have led to the uncovering of the fraud earlier. This concludes our presentation on WorldCom. Thank you.